Thank you. So hopefully you can all hear me a little bit better now. So I think one of the interesting things that we've seen, this year, there's been a lot of discussion about how the funding climate has become more difficult. So I want to start by talking about what that has meant at the early stage. And I thought maybe we could kick things off with Josh, if you could tell me, just what the change in the climate that we've seen since the fourth quarter of last year has meant for early stage companies.
It's funny. I mean, we're a $1 billion fund, so we focus mostly at the Series A, Series B level, and those terms are all so fuzzy right now. That's really like the first check is a $5 to $10 million round at a Series A, and a Series B can be anywhere from 10 to 15 million up to 25 to 30 million. Series B is what we're seeing these days. We aren't. I think if you go back a year ago, things were sort of such a heated market that if you were coming out of Y Combinator with any kind of interesting company, it was really easy to raise $1 million and pull that together. And if you were then showing a little bit of traction, you kind of put together a $4 to $6 million Series A a lot easier. We've seen it reset, but I wouldn't say to like the cold winter. I would say we've seen it reset to what people have been around my firm a lot longer than I have say is actually just pretty standard, which is people with some real traction, momentum in their business, kind of a good big plan, are really having no trouble raising money. And people who kind of haven't sort of unlocked that imaginary like product market fit or haven't kind of figured out exactly where they want to go are really struggling to raise. And we think that's actually a pretty natural sort of culling, because venture's always been an industry of looking for those really big outcomes and sort of those ones that kind of really hit that momentum.
Got it. And Charles, I wanted to ask, with your focus on the seed stage, what are you seeing there this year?
Yeah, I think the biggest difference I've seen is I think everything in venture has a tendency to trickle down. So I think if 2 years ago it was harder to go from seed to Series A, I'd say today it's harder to go from that sort of pre-seed or angel round to institutional seed. And I think a lot of that had to do with the fact that 5 or 10 years ago, a big seed round was $1.5 million. Today, a big seed round, I've participated in 3 this quarter that were between $3 and $4 million. So when you get to the point of raising that kind of capital, obviously expectations are a lot higher. And I think sort of the friends and family pre-seed crew is adjusting to what the seed folks have in terms of expectations for what a fundable company looks like at that first kind of significant institutional stage.
And can you walk through a little bit just how those metrics have changed specifically?
It's hard for me to say. I tell all of my companies something that I think is a little different than they typically hear. My experience has been that the metrics that you need are the ones that the person who's already fallen in love with your business can convince themselves are significant. So when people ask me, what do I need? Do I need 25,000 in MRR? Do I need 100,000 DAU? I have companies that I've worked with at SoftTech and Precursor that had amazing metrics. No one liked the market or business they were in. They were unable to raise. I have companies that had very thin metrics by any measure, really compelling entrepreneurs, really big idea. They were able to raise with no problem. So what I tell people is, remember, Series A investors can do 2-3 investments a year. You have to be so compelling and outstanding that they want to bet one of those few slugs on you. And I tell people all the time, it's hard to know until you get out there, but I think metrics are part of it, but never lose sight of the importance of story and scale of the opportunity you're going after.
Got it. And obviously when we talk about early stage investing, one of the major players are angel investors. And Arielle, before you joined Kleiner, you were active as an angel investor with companies like Partender. Can you talk about kind of how you see the role of an angel investor now and how that perspective has maybe changed since you've joined Kleiner?
Yeah, so I'm actually seeing a lot of angels coming in at A and B rounds as well now. People like to fill out the round with some strategic minds. I guess, I don't know, the key, what are the differences, or what would be the most interesting?
Sure, yeah, do you see a significant shift in how angels are participating in this environment now from when you were on the other side?
Not especially, honestly.
Okay, got it. And so also the accelerators, obviously at the early stage, play a significant role. And in the past year, we've seen a lot of these programs increasingly look internationally. Programs like Y Combinator, 500 Startups always has, but doubling down on those initiatives. Dave, could you maybe talk a little bit about how that's played a role for Techstars and how you're looking at that?
The international piece specifically,
yes.
Yeah. So, we run about 25 accelerators now a year, and most of it's still in the U.S., but about a third now in Europe, places like Israel, South Africa now. It's been interesting to me to watch the verticalization of the accelerator industry and the sort of internationalization. Our approach has been to get out there and participate in the communities, and others are trying to draw people here, right? So it'd be interesting to see how that plays out. But we saw things like Brexit sort of freak out people, and London, we have 3 programs there. But the pace of investing at the early stage, from our perspective, just sure, valuations are getting more sane, but the pace is still very high. There's a ton of capital out there. A lot of funds for seed stage raised in 2014, 2015 that are being deployed. So we're actually seeing a pickup internationally as well.
Mm-hmm. And Roy, what are some of the biggest challenges you think, working for Google's program, when people who have kind of the Valley mindset look abroad for investments, what are some of the pitfalls that they can run into, especially at the early stages?
So 2 things that we're solving for in the program. One is, hopefully in a couple of years, we'll get to a situation where if startups wants to be successful, they don't have to actually come here, both for raising the funds and also for having access to the talent and the professionalism that you can find here. That's one side. The other side that we're solving for is, I would say, more awareness of the kind of solutions and the kind of innovation you can see in emerging markets today. So every time we're bringing a Miraculous or any other company that solves for, I would say, the real problems that the world needs solving today, and we show Silicon Valley investors and professionals that there is a lot of knowledge and a lot of innovation coming from these markets, so that's a viable opportunity they should be looking at.
Mm-hmm. And, Josh, I wanted to kind of talk to you a little bit about a blog post you recently wrote. So one of the things that comes up a lot in recent months when we talk to early stage companies are the challenges in the app economy and how difficult it is to get people to download new apps. And you wrote a post recently about how the next best platform is the one we already have, talking about mobile. So can you talk a little bit about that and how you're thinking about that when you're looking at some of these companies at the early stages?
Yeah, I mean, I think there's this sort of meme out there that says, oh, no one's downloading any more apps. We're kind of done. There's no new invention to be had. And I just don't understand how that's possible. We have 1 billion plus people with computers in their pockets that they're using all day long. And yeah, we're doing a lot of things on them right now, but by no means have we moved so much of our lives. Is it working simply? Is it working the most effectively for us? People said the same thing about the consumer internet back in 2002, that it was just dead. There was never going to be another big website after Yahoo and Google and eBay and Amazon. And then all of a sudden people figured out social networking, and those became really massive, important websites. And I think we're just going to see that we're seeing the same thing now. Pokemon Go just this summer had over 500 million downloads and got people out doing a new behavior that they've never done before. And I think it's that kind of creativity and that kind of inventiveness that we need to see. But I just think we're ready for kind of, call it mobile 2.0 in the same way that social was web 2.0. But it takes people to think outside the box. It's not another photo app. It's not another way to order something that gets delivered to you and there's a new transportation network that's delivering it. It's really different things you can do with the fact that we're all connected, always on, and there's 1 billion plus people around the world doing it.
And so I just wanted to follow up about Pokemon Go, because obviously that's an example of a product that had some major companies coming together to work on that technology. Do you think it's still possible for a company at the earliest stages to have a product that creates that type of impact?
Oh, absolutely. I mean, last summer I invested in a company called Musical.ly. It's actually based in Shanghai, China. And they had been in the market for about 9 months tinkering out with the product, and all of a sudden they hit a real vein of young kids turning their phones on their faces and creating an actual music video, lip syncing to songs. And now that they've gone from to over 10 million users using it every single day, mostly in the U.S. and Latin America. And that's just an example of they were when I first met them a year ago, they were like 12 people in Shanghai building this product, and they've grown massively. Another one that we just announced today called House Party that I'm involved with, a former team was formerly building Meerkat. They hit #2 in the App Store and had over 1 million people download and play with the product in a very short span of time, all through word of mouth, because it was something that was really cool and different for them. And they've just kind of rebuilt a lot of the technology and relaunched it today. And we think we're hoping for the same kind of growth.
Got it. And So I just kind of wanted to run down the line and maybe do kind of a rapid fire question. So what's the biggest red flag that you can see in a startup's first pitch? Yeah, we can start with Charles, maybe.
Co-founders who fight or can barely contain their contempt for each other.
I think excessive name dropping.
Lies and stupidity.
Not having a real reason for one to be there besides make money.
Agreeing amongst each other on the story of what they're about to do.
Nice. And maybe we'll start at this side this time. What are some of the areas that you're most excited about on the early stage investment side?
So I'm biased. I think for me, it's solving emerging market problems.
I think I already answered that one.
Making videos with music, that was it. Yeah. Right. That's important. I don't know. I get excited about. It's important. I get excited about the big ideas that solve big problems. I think often we're criticized at the early stage for not funding things that necessarily are going to do so much good. So things that can really fix major problems. I think more startups that have all this talent should go after that.
I think AR, VR, and the future of work in a freelance economy.
Based on my last 5 investments, women's health.
Got it. And so I did just, Arielle, want to kick it back to AR and VR. What role do you think new computing platforms like those play in early stage investment right now? How important is it when you're looking at a company that for them to be in AR, VR, messaging, one of these areas that there's a lot of talk about right now?
I think there needs to be good content in order for these platforms to be successful. So primarily looking at companies that drive entertaining experiences, social experiences, because I don't think consumers are really going to go for these products if there isn't anything interesting to do.
Got it. And so one of the biggest questions that we're talking about today, we've seen a lot of top companies here, but just for startups who are just getting into this, founders, how can they set themselves apart in such a crowded environment? Maybe let's start at this end with Roy this time. We'll just keep going back and forth.
So I think it's thinking big and really looking at finding that solution that would scale. I would also take the time in doing a lot of the research and really showing that you understand your market and you understand where you're going to.
Look, at the very beginning of launching a product, you have to make something and figure out how to get it in the first people's hands and get them to love your product. And you don't need to do heroic things. Turns out around you, either people you know, people in your community, people in communities that you can access, you can find those first people to do it and to really get the product right for them. I'm much more interested in meeting a company that has found a few people who love their product and has ideas about how they're going to replicate that at scale than any other numbers of lots of people who've tried it or figured out how to market it without really finding that early just love and passion for it, and you've really built something that changes people's lives. And it takes a lot of hustle and grit just to get there, but that's the most important thing, I think.
I think if you think about the 15 or so companies we saw here today and think about which ones stand out in your mind watching it, for me it's always about the purpose-driven entrepreneur, and you sort of alluded to that. It's someone that has a real intrinsic source of motivation for what they're creating often is what stands out to me. So just being real about that and not starting your companies from a spreadsheet but from the heart.
Yeah, I totally agree. Passion and the fact that you've done your homework.
I would just say unique insight plus probably an irrational amount of persistence. Most of the best people I've worked with have sort of stuck to the core of what they wanted to do through several failed cycles and have never been deterred about the value of what they're building, even if the original tactics and approach didn't work.
Got it. And we've only got about a minute left, but I just want to ask, obviously, we've got a little bit of a biased panel here, but could you each maybe share one seed stage company that you've seen recently that you're really excited about? Maybe Charles, if you want to start.
I'll do one that's not in my portfolio, Dia & Co.
Series A, right?
Yeah, this is Series A.
Yeah, I really like Dia & Co. as well.
Really? I don't know. I just, we have so many that it's hard to pick one. But I'll go with StatMuse, which is sort of analytics for any complex data set that you can speak to. So they're doing sports at first.
Very cool.
I've been tracking a bunch of things in sort of the gaming space, and there's a new Trivia Street game that came on my radar that's doing it through Facebook Messenger that's actually starting to attract large numbers of people to come together at the same time and play trivia. It's fun.
Very cool. What's the name of that?
Trivia Streak.
I'll have to give the politically correct answer of saying all the 48 companies that we've accepted to the accelerator.
All right, and with that, we'll have to wrap up. Thank you all so much for your time.